So today we are going to look at the top 3 trade setups which I uh, like to trade. So let's start by looking at this chart, and this is a profile chart for Nifty, and what is immediately obvious to you is a nice trend. Now, in market profile terminology, the way we define trend is by means of higher value area placement. So you can see that here the value area moved higher. Once again, it moved higher. Once again, it moved higher. Here also it was higher. So basically, the trend of value area placements is what decides if the market is trending or not in market profile terminology. Now, this is quite true that higher value area placements mean that the trend is up, but at some point in time there has to be a change happening in the markets. And just because the value area placements are going consistently higher does not mean that the trend is going to continue forever. There will be signs which we can monitor, which tells us that the trend may be exhausting or may be coming to an end. So in this particular example we are going to look at how the trend exhausts. All right, so let us start. Let's look at the next chart. Now here is a chart where you can see what I'm trying to say. Now, even though the value areas were being were forming consistently higher as shown by the green boxes, there are a few more things that were happening on this chart. And first is, you will notice that there were P shapes forming consistently. Now, what that means is, even this is a small p. So what that means is that a P shape is usually a sign of short covering, and what it means is that smart money is actually coming from the other side. Short covering is basically when the traders are forced to cover their positions. Usually these are the traders who are not very experienced, or amateur traders as I call them, and they get into wrong positions and they are forced to cover. So maybe all this time, uh, these traders either were covering their shorts or they were buying every pullback. So another sign of amateur traders is they just go right into the top and keep buying. So here also it was happening. Every time the price came down, they bought. Every time the price came down, they bought. And when they bought, they were being supplied by the smart money. And then what happens, we'll see in a bit. So these are subtle signs which start coming up. Another important sign is the poor highs. As you can see, there were 2 of them. So what it means is that the market is continuously facing exhaustion, and that means some opposing force is coming into the markets, and that is stopping the free flowing movement of the markets. Also, you will notice another sign is that the ranges are limited. You can see the range is limited here, the range is limited here, a very narrow range to begin with, and also prominent points of control. So when the value areas are very thick or very wide, that is a sign that the trade facilitation is not as good as we expect. So what are the signs of a weakening trend? Narrowing ranges and value areas, overlapping value areas like you can see here, and poor highs in case of uptrends and poor lows in case of downtrends, and consistently poor structures like P shapes in an uptrend. That tells that the opposing side, opposing party is slowly gaining control. So what happens after that? Once we see all these signs of weaknesses, we get the inventory adjustment break. Now why I'm calling it an inventory adjustment break is because we are seeing signs of exhaustion, uh, you know prominent points of control, poor highs, P shapes. And when all this is happening, what happens is that suddenly there comes a time where there is no more buyers left in the markets. And when that happens, unless and until fresh buying comes into the market is not going to go up. So if everybody is kind of have bought already, what happens is that there is nobody left to push the prices higher. And smart money is usually very observant of all these things. So what they do is they also stop buying, and they just stand aside. And when they are not supporting the markets, what happens is that markets goes into a free fall, something like this. And why this happens is because even when the prices are lower, all the amateur traders have already bought. They just bought right going into this top, and now the nobody is left to buy. And suddenly, the smart money, who is usually supporting prices at lower levels, is not showing up, and they just stand aside and let the markets fall. Because then what they can do is, once this free fall is done, they can start coming into the markets at really advantageous prices. If they still feel that the trend is continuing, what they'll do is let the prices fall sharply. All these amateur traders, they panic, they throw in their positions, and that is when the smart money is coming in. So smart money is operating on many time frames. It's not necessary that they are operating always from the longest time frame. So there are multiple time frames where smart traders are there, and they you might say that all these traders, they were selling but the prices still went up, so how are they smart? So what happens is, these guys are trading on multiple time frames. Sometimes they are hedging their positions. They are using all the developments to establish positions in next series, and all those things are happening. They are doing trading on multiple dimensions. Sometimes they have cash positions which they try to hedge using the futures, and all those things are happening. And that is why it's really difficult to basically point out what exactly is happening. So what happens here is, the market gets exhausted, then we get a sharp fall, and this is where the accumulated shorts were covered, and this is where the amateur traders were getting thrown out of the market. And that is when they come in, the smart money, and they absorb all the supply. So this is the inventory adjustment break, and the reason why you should be observing these signs of exhaustion and this poor structure is because it's usually very dynamic. People think that the trend has changed, and it's really volatile times to think about what you're going to do. So unless and until you're prepared beforehand and you're open to a possibility of such a break, actually this break can be used to establish or add to your long positions like the smart money does. So it's really important that you keep track of this particular pattern if you don't want to get caught in sudden volatile move against your position. Okay, so the next setup is absorption. This is probably my favorite one because I keep using it all the time as and when it happens. So this is the same development. This is the free fall, and then the price is thickening. Here you can see that volume is getting attached. We are moving sideways on time. All these are signs that smart money is coming in, and all these weak traders who were throwing their positions were absorbed by the smart money. Now this is the sign that smart money may be coming in, but we need some confirmation, and that is what we get on the next day. Let's look at the next chart. Okay, so this is an important chart. A lot of things are happening. This is the free fall which I was talking about. Here is where the smart money enters, and see what happens on the next day. We open higher. Then we try to come down, but this whole volume which was getting attached on the previous day, these were smart money buyers, and they defended this price zone. So we move back up. And then as you can see, the price tries to rise. You have nice one time framing going on, but at the same time there is a lot of overlap between the bars. So, and then we have this poor high in F and G period. So all these are like signs of exhaustion. Now you have a sharp fall on the prior day. The next day you move higher and you see prices exhausting. This is a classic sign of a pullback, and the downtrend should resume. Now that is what normal traders would think if they are just trading price. But we know that this fall was most probably due to accumulated exhaustion signs over the last few days. We had multiple poor highs, prominent points of control, narrow ranges, P shapes. So all those were signs of exhaustion. And this fall was just trying to balance out the inventory. So this was not really a start of a new downtrend. And that is why when this exhaustion was happening, I was actually thinking that, okay, this is the rejection zone where the prices fell sharply, and we are accepting in that zone. It means that any supply that came into this zone is probably being absorbed by the buyers. And this sign of exhaustion came. Now even if you're trading price and you see that there is a sign of exhaustion matching highs, what is your immediate point of attention should be that if this exhaustion does not get continuation in the direction of the main trend, in that case something is wrong. So here also that happened. We tried to come back down, but we again form a poor low. What it means is that if this is exhaustion and the sellers are piling up onto shorts on this pullback, they are not of the smart variety. They most likely are momentum traders looking at the prior fall and then just blindly piling up on shorts on the pullback. So they did not get any follow through because they don't have the strength. The strength is from the other side. The smart money is absorbing all the supply that is coming in here. They absorb the supply here first, and now they are absorbing the supply in this particular green box. And look at the follow through, and look at the follow through on the next day. So they absorb all the supply, and once all the supply is absorbed, all the market has to do is to rise up. So that is what happened, and we got a nice move out of it. So that is the second setup pattern development. I don't like to call them setups because I hate that word personally, but these are the market developments which you should be tracking if you want to take some great positions. Then there is the fresh breakouts and breakdowns. So usually when a person starts out with market profile, he gets hung up on different day types, profile shapes. James Dalton has given us the P and the B shapes, so they were very popular. But what do they exactly tell you? And what matters is it's not always a short covering or long liquidation. And even if it means that a P shape is short covering or a B shape is long liquidation, what is important is you have to see who is liquidating the longs. Are the smart money really from the buy side in case of a B shape? All those things you have to worry about and think about and observe on the chart. Otherwise you will get trapped into the same a problem which happens with traditional technical analysis. You get hung up on patterns, you don't look at the logic behind it, and then you start taking wrong positions. All right, let's start with this fresh breakouts and breakdowns. So what happens here is that you have a nice 3-day composite forming a very prominent bell curve, nice volume profile, nice gradient at the ends and nice thick volume profile. So whenever such kind of a development is happening, what it means is that the sellers and the buyers are in balance. And if the prior trend was up, then this balance will mean that the buying strength is now being matched by the selling strength. So any buying strength that was there which was causing this uptrend is now matched by the selling strength. So usually this is a sign which tells us that the first leg, so to say, of that move is over, or maybe there is a possibility of a top forming here. And then on the next day something interesting happens. You get almost an unchanged open, because this is where the last of the 3 days closed, an unchanged open, and then sharply prices move down, and then for the rest of the day they form a nice V shape. Now people start thinking that this might just be another inventory adjustment break, or maybe smart money is stepping in here. Now whenever you start thinking that, usually you have to keep in mind that it's not always possible to predict the future. Actually it's never possible to predict the future. But even when you are using market profile, what is more important is how the markets follow through after that development. So here already we had a nice sideways move. Exhaustion is something different, and this kind of development is something different. Here what was happening was, for 3 days we were forming sideways value areas, and that is usually a sign of either distribution or reaccumulation if the prior trend is up. So we had the possibility of distribution here, which was not there in earlier chart, and then we get this follow through. So once you look at it in the whole context of possible distribution and then prices moving lower and forming a B shape, that is usually that actually gives you more confidence into possibility of markets going down, and this might be at least a short term top. And that is exactly what happened. So whenever you see a B shape, don't just jump on to conclusions. You have to look at the development in the complete context and then arrive at a decision. And even if you are not short on this particular day, you can see that the next day opens lower and again drives out of the range. So if you were not confident on this day that the sellers have taken control, this is probably as much information as you need to confirm that sellers are indeed in control. Okay, let's look at an example of a breakout. Okay, so here again an interesting chart. You see that sideways move was happening, composites were forming, and then we move sharply lower, nice elongated profile, and that immediately tells us that supply was coming in this particular zone. So this becomes our supply zone. We marked it. 9880 is the level, is the HVN, but you cannot just look at one number, you have to look at a zone. And then after this nice continuation down, what we get on the next day is a nice balance. Just a while back on the prior chart only we saw what this means. So if you have a nice trend and then you hit a nice bell-shaped curve, it means that these sellers were being matched by the buyers. So that tells us something, that buying is coming in, and if not the trend is going to change completely, but at least we might see some pullback. And immediately the next day we get a nice higher open, and then we move higher, and this was the supply zone which we talked about, 9880, and see what happens. Prices get resisted right here. This is how strong these principles are. And then you move down. Now close at the lows, the trend is down. We got resisted at an important reference. This usually is taken as a sign of complete weakness. A pullback has finished and we are now resuming the downtrend. But always remember, the value area placement is the most important thing in market profile, and that was way higher on this day. So even if there was a possibility of continuation of the downtrend, looking at the higher value area, I would not jump into shorts. And clearly enough, next day opens higher, it rejects this late down move of the prior day, and then just forms a tight balance right at the reference. Now let me clear all that. This rejection was good, in fact, because it came at the reference and got rejected immediately. It comes again at the reference and there is no rejection to the downside. The prices just stay there. Now, if the selling was coming in, prices should have moved down. But despite selling coming in, because we know that this reference is a supply zone, price is not moving down, it tells us that somebody is buying all that supply. And that is where, the absorption principle comes in, which we saw earlier. And here again, you see the same principle. We are absorbing the supply. So smart money is active here. They first came in here and stopped the down move. Then we had a higher value area. Again, the momentum traders came back and shorted the market, but smart money was on the other side. And now this is kind of a clear sign of absorption. And see what happens on the next day. We get a P shape. So this was an important supply zone. This was sign of absorption, and then we get a P shape. Once again, no voice market profile traders will look at it as short covering, and they try to fade that, but then the price just keeps moving higher because this was a genuine breakout. Once we broke out, all those who were trying to fade the markets, all that supply was absorbed for 2 days. For 2 days, we form narrow balances above the breakout zone, never come back down to even test it, and all the supply is being absorbed, and then you get the continuation to the upside. So this is how, most of the breakouts and breakdowns, they happen. So if you are breaking out of a nice congestion zone, or above or below an important supply or demand reference, and you get a P or a B shape, then P in case of breakouts and B in case of breakdowns, then you have to be very careful not to immediately classify it as short covering or long liquidation, but you have to be very careful about that, and analyze the development in the current context.